Okay, guys, welcome back to Basics, episode 24. We are 95% sure that's the episode we're on, where we're doing statistics.
Yay!
Yay! So, if you're new to this series, is where I take my lovely fiance Jessica, and we are teaching her how to trade. So, again, we are 24 episodes in. That's a long time. On both of our channels, there's a playlist that includes all of the episodes in order. Feel free to go through there, get started. Again, we've done market mechanics, we've done technical analysis, we just finished fundamental last week, and now we're doing statistics. So we're quite a ways. I would say we are past the halfway point until you're trading on your own, real
Oh
cash.
wow.
So this is very important, and I don't know how I'm going to make this interesting to you because I know you hate math. Now, I never am going to expect you to be one to get real deep into statistics, but trading kind of in and of itself is a bit of a random occurrence, right? The same with everything. There's an aspect of probability in all of this where you can do everything right and have bad outcomes, and you can do everything wrong and have good outcomes. So one of the main reasons of statistical analysis to make sure that you're always have your brain in a mode of I don't know what's going to happen. There's a certain amount of probability to it. Let me see if I can stack those on my side. And the other analogy I like to use is that so you're a dental hygienist by trade. You making more money, doing more work has a lot to do with the absolute direct effort you put in at that time, right? If you came in and you slacked off and you were really slow and these type of things, you it would be harder to get new jobs, right?
Okay.
Whereas in trading, it doesn't that work to reward isn't quite as obvious. And I like to use the analogy of like a sport. You know, if you were a boxer, you wouldn't go in every day and box someone full tilt, right? They spend most of the time, you know, if you're a boxer, you're spending most of your time working out, you're hitting the bag, you're like sparring with people, you're working on techniques, you're doing things like this, right?
Mm-hmm.
And it's the same with trading where the actual act of placing a trade is just hitting a button. Right? The actual act of hitting a trade takes a second, right? You're just in, that's it, you're out. Whereas all of the work is done before and after and during the trade, where you're working on yourself to get better, to pick a better trade, to place it, right? So that's a lot of where the statistics come in, where whether you're doing it with math or whether you're going back through charts and drawing lines or whatever it is, you're looking for past occurrences that are occurring again that have you think they have some sort of statistical edge to them, right? So all the patterns that I went through when we were talking about technical analysis, that is kind of in a sense statistical analysis as well, because all statistical analysis is, and this is my rant here to demystify it, is studying past occurrences to see if there's some sort of correlation with future results, right? A descending triangle. How many times can you study that in the past until you are sure under what circumstances that it works has gives you that statistical edge? Lost already?
Okay. All right. Let's get started.
Uh,
Statistics.
you'll have a blast. So again, here's our socials. Follow us both in these places. If you're watching on my channel, Jess has the next episode already up and running. If you're just interested in following Jess, she's going to start posting some of her own videos and just, you know, going through the journey of this beginning to trader. So you'll see when things go right, you'll see when things go wrong, which again, I think is the real power. There's enough of, I've been doing this. People only start this when they're been doing it for years. So I think it's good to see someone's kind of road there. So, statistical analysis. We've done this every time where there's pros and cons to each type. And it's important to note that none of these are going to be your sole focus. It's going to be always some combination of the three. And then, you know, think of a Venn diagram. Wherever you land on that Venn diagram is going to be up to you, right? There's people who do a lot of fundamental and statistical work, and then they just use technicals to, you know, see where the prices are. So, the first pro is great for handling human biases. And that's actually what the next lecture. Next, we're going to do a practice, and then the next lecture is going to be all about the known statistical human biases, how they affect you. I think it's important that when you read them and you know what they are, it helps you know when it's happening to you. So, anchoring bias, framing bias, there's all these biases that we know happen. And I think that I'm actually excited for that one. I think it's going to be really cool. Kind of teaches us how bad we are at knowing statistics in our head. So it removes all of those, right? The numbers are the numbers.
And you're like, those biases you were just talking about, I'm not supposed to already know what those biases
No,
are.
no, no. That's what we're
okay.
going to go over.
Okay.
Some of them you'll hear, you've just heard through life. The easiest example that I'll show you, and again, this is, I guess, just a tease for the next one. It's framing bias, which means basically if I give you two problems, if I say, listen, there's a train coming and there's one guy on one track and six people on the other track, will you switch the track to kill the one guy as opposed to killing the six people? That's really, really hard. But if I frame that in a different way, saying that you would save six people in the cost of one life, the same question gets flipped on its head. But anyway, there's 10 biases or so we're going to go through.
Okay.
And gives you a full understanding of your trading style. And what I mean by this is that when you run a back test, which we're going to show in the next episode that you can do in trade ideas, it helps you see what exactly that trading style is good at, what it's bad at. You know, if you go through and you say, okay, over the last 6 months, there was a 1 month period where this strategy sucked, and then it got better after that. That will help in your head when your trading strategy starts to suck in real life, because you already have an example of when it was bad, but if you continued to kind of trudge on with it, it became profitable over time. And it's a good way to see that kind of in the numbers before you start trading it. Next is less stress. And this one I'm kind of huge on with statistical analysis, because you know what the odds are. If you run a back test on your strategy and you say, okay, this is 55% accurate, then when you take those losing trades, which is about half of every trade you make, it just makes it easier for you to get through that stress, because you're like, this is just part of it. I've done the tests. I know this is part of it. When I have a bad day or a bad week or whatever, it's just part of it. Cons are it's not good with nuance. So when you run a back test, you're basically just grabbing all of the data in history and you're testing it based off your current strategy. But as we know, the world is constantly updating and constantly changing. There's new technologies, there's new governments, there's new ways that people think about things. For example, if you ran a back test 100 years ago on how well computer companies did in certain areas, you wouldn't be able to do it because they don't exist, right? So it's not good with this nuanced things. The other thing is only tested on large numbers, which is good. It's a good thing and a bad thing. The bad part of it is that it's very hard for the brain to comprehend large numbers. So it's easy for me to say, you're only going to be right 50% of the time. But as you know, with some of the paper trades you took this week, and you were right about 50% of the time, but it still hurts that other side of the time. So even though we can look at it and say, over 20,000 trades you'll make money, it doesn't help when you take that one trade that doesn't make money, right? That's complex. I put that there. It will just scare some people off entirely. When I talk about statistical analysis, these videos will probably get viewed less than the technicals. So what I'm going to try to do is not get too numbery. Let's feel, I guess, another way to do it. There's a lot of traders out there who've been doing it for years, right? So sometimes if you spend too much in the numbers, you don't spend enough time kind of in the feel of things. Now that we're out of the way, and I've been ranting for probably 10 minutes already, the sole purpose of this exact lesson is just terms. I want to teach you all of the terms this time so that when we get into it, you understand kind of the lingo, right? First one's win rate, which is fairly obvious, but here's just the math behind it. You take the number of winning trades and the number of losing trades, divide it by the number of total trades times 100. So basically, if you took 100 trades, you would take the 50 that you won, right? You divide that by the 100 trades that you took, you got a 50-50 win rate, right? This here is just a clip of trade ideas. So this is how trade ideas outputs this data for you. So that's why I've included it in each of these, right?
Where is it?
See total trades. It says
Yeah.
129,
Okay.
41% winner. So that's how it does that math. It takes that 129 trades, and then it takes the amount that won, and it just shows you the win percentage.
And this is off the back test?
Yeah, yeah, off the back tester. And also, when you get real trading, Trade Ideas is going to build this in, but until then, you're going to do it yourself, where you're going to record all your trades in a spreadsheet, and you're going to get your own how accurate am I.
What if I'm like trading left, right, and center?
You got to be recording left, right, and center. Again, I guess this is a sneak peek for the people who watch this. As a consultant with Trade Ideas, I talk to them a lot about this, and they are going to build this. Basically, what it will do is it will do that for you, where it will sum up all the trades you made in Brokerage Plus and tell you what your win rate is, average win loss, all of these things. And this is just me. And I put don't matter, and I know there's no apostrophe and it's spelled bad, but that's the whole point. Is I've got this series where on days that I'm up pretty big and really suck with a win rate, I go out and I tell this. And because a lot of people, they come to us and they say, what's your win rate? Or they come to me and they say, what's my win rate? Doesn't matter. This day I was right 45% of the time, and I made about $500 or so, right? This one I was right 28% of the time, and I still walked away with a profit, right? So it's important you know these things, but know that we in this household don't focus on win rate. But again, it's still important. Risk reward. So this is essentially how much you make when you're right versus how much you lose when you're wrong. And we'll talk about it in a second, but this profit factor is kind of the be all end all. But you can see with this strategy, even though it's only right 41% of the time, still makes a bunch of money, because I make $2, and that's what this number is here, $2.21 on my average winner, and I lose 84 cents on my average loser, right? And that's it. That's the ratio. But I put IMO. This is the most important stat of trading, because again, as we saw, even with a 28% win rate, it's still possible to make money as long as you manage this risk reward. And then the other thing is, this is what you can control. Your win rate, when you put on a trade, you put on the trade and that's it. But the difference between traders that make money and traders that lose money, which it took me way too long to figure out, but I did, is the ones that make money make many times more when they're right than they lose when they're wrong. And you can control that by making sure that when you're wrong, you're out super quick, right? Other thing to note is these are generally speaking inversely correlated, which means that the higher your win rate, the less your risk reward, and the lower your win rate, the higher your risk reward. And think about it like this. If you bought a stock and you said, every time it moves 1 cent in my favor, I'm out. Every single time. I'm going to buy a stock, I'm going to put a profit target 1 cent out. And if it goes $5 against me before it goes 1 cent for me, then I'll get out, right? You would be right a lot of the time.
Mm-hmm.
But for every one of those losers, it would wipe out literally 500 winners, right? So they skew depending on how much you're trying to make when you're right. You'll get a lot of times where it will go a little bit your way and then maybe come back, and that will count as a losing trade. This is why I kind of completely let go of caring about my win rate and only focusing on one side, because the more I tried to make both work, the more I was beating my head against the wall, right? You make one better, you make one worse. Profit factor. So this is kind of the last one, but profit factor is kind of the summary of everything. It takes these two numbers and it adds them together, right? So profit factor mathematically is all of your winners divided by all of your losers, right? So if I made $100 on all my winning trades and then I sum up all my losing trades and I lost $50, that's a profit factor of 2.
Okay.
Right? So it doesn't matter how many winners and it doesn't matter how many losers. It just sums up the total dollar value of all of your winning trades and the total dollar value of all your losing trades.
Oh, okay. Not
Right.
the amount of trades you placed, but the amount you
made or lost.
Okay,
Yeah.
gotcha.
So you can see this particular strategy has a profit factor of 1.86. So it means it basically takes the win rate, because that's going to matter, and it takes the average win loss, because that's going to matter in the equation, and it sums them all up.
Got it.
Do you?
We'll see.
The way you looked at it, but The only thing that's important with this is so a one profit factor would mean you make and lost the exact same amount. So you netted nothing,
Okay.
right? If your profit factor is negative, that means that you lost more than you won,
Mm-hmm.
right? So a profit factor that's positive is what you're looking for. And this is the number that I focus on more than any other number because it incorporates both of those other numbers into the system,
Okay.
right? So a profit factor of 1.5 and up, I consider good,
Okay.
right? It means that, put in simple terms, it means for every a profit factor of 2 would mean for every $1 I lose, I make $2 somewhere else,
Okay.
right? So you could think about it as if you ran a store, you bought that widget for $10 and you sold it for $20. So essentially, kind of your profit factor is 2 because you lost $10 when you bought it,
Mm-hmm.
but then you gained $20 when you sold it. Same kind of thing.
So why isn't it just called profit?
Well,
Oh,
because
because it's okay. It's
it
not it's not the big number. It's just the
right, and
gotcha.
you think if you reported profit, actual profit, that would be useless, and we talk about that a lot. If someone came to me and said, "Hey, I made $1 million," great. That's one. How big is your account? How much did you risk? How much? There's so many other things, and this number kind of
I was
includes
up
those.
$600 on my trading account, but apparently they were garbage trades.
No,
Most of them.
half of them were bad, and half of them were good. You'll go over those
My
in your
little video.
videos. So stay tuned. So types of backtests. There's two ways to run backtests, and this is important because trade ideas and the backtester you're using is one specific type. The one to the left is what's called it's called single stock backtesting. So this is a chart of AMD. It's a line chart with two moving averages. Remember we went over moving average crossover strategies. A moving average crossover strategy is when a short-term moving averages crosses over a long-term moving average.
Of course, I knew that. Jeez, what do you take me for?
But the point is that this is done on AMD, and basically, which is a computer chip manufacturer. They make processors that goes into computers. So essentially, what this is just saying is that you look at this one stock and you say, how does the stock perform if I do this, right? If every time there was a head and shoulders, how does that work on this one stock? And then you get all these results. That is a form of backtesting that most places have. It's got a lot of problems with it, and the big ones being that you're only looking at that one different security, and what if the trading strategy works on that security and not on others? But for people who only trade a certain number of instruments, that's all they care about. I told you there's people out there who just trade gold and oil, and so they do single instrument back tests where they say, okay, I want to find out what works best on this, and I'm going to continue to trade that going forward. Trade ideas is what's called an event-based backtester. So what you can do is you can say, for example, I want to know every time a head and shoulders occurs on any instrument, go, and it scans the entire market and then goes back in time and tells you how that works across all the different stocks. It is way more computer intensive, which is one of the reasons that Trade Ideas is so good at this, is because they've got really powerful back-end servers. The downside to it is that as you're starting to see, every stock kind of trades and looks a little bit different, right? Some of them, the charts look smoother, and sometimes they look choppier, and this kind of thing. So it's important that when you're building these back tests, and this is for you guys out there and for you in the future, is that you understand that very simple concept that every single chart and every single stock in the market has a little bit of a different flair to it. So doing these giant back tests on all of them is great, but what I generally do is I use these back tests to give me an eye of what to do, and then I narrow down into actually looking at the stocks so that I can see the character of how that stock moves, whether it's a clean or more dirty mover, that type of thing. Are you already tapped out of statistical analysis?
No, but I'm getting there.
Oh, well, this is one of many lessons. This is a very important topic. Again, I'll try to make it as high level as possible. Next one will be interesting, I promise. All right, guys, that is it for this one. Next one, we're actually going to do another theory to practice where I'm going to show Jess the back tester, how it works, different things you can do with it, see if you fall asleep or if maybe it's something you're interested in. But more, we're going to go how those particular terms apply to a back test that is run in real life. And then the following week will be about these cognitive biases.
Okay.
Awesome. All right, guys. See you next time.